Hello and welcome. In this lecture video, we will continue our discussion of stock dividends. So in the prior lecture video, we talked about small stock dividends, and we also talked about why a company would issue a stock dividend rather than a cash dividend. And so what we said with the small stock dividend, that's 25% or less than the outstanding shares, we will debit retained earnings for the market value of those additional shares. In this case, we had that 100,000 shares, 2% stock dividend, so 2,000 new shares that will be distributed to our stockholders, times the market value of $10. So we debit retained earnings for the market value, and then we credited our common stock distributable for this $2,000, and then we credited our paid-in capital, which was our difference right there between the par value, this is based on the par value, and then the market value. And this was on the date of declaration. And then on the 20th, we removed our common stock. Sorry, just catching up there. There we go. Now it's better. We debited our common stock distributable for 2,000, and then we credited common stock for 2,000. So basically, what we're doing is we're moving it out of retained earnings portion of the statement of stockholders' equity to the capital section, or the common stock section of our statement of stockholders' equity. Okay, so remember, debiting retained earnings decreases our retained earnings. Okay, and so that's what I was saying right over here. This common stock dividend distributable account is an equity account. It's a temporary equity account that we use for our date of declaration. It's not a liability. It's just a temporary equity account that we use on the date of declaration, and then on the date of payment, as we saw when I flipped the page over, I debited this and then I credited common stock. Okay? So when we look at our balance sheet changes when we issue that stock dividend, and we talked about this a little bit already, but I'll just go over it one more time. So the amount of equity that's attributable to common stock increases, and then retained earnings decreases. So I'm basically moving it out of retained earnings into paid-in capital and our common stock. So if you look down here, right, these are different numbers than what we worked with in that prior problem, but you can see what's going to happen, right, is it's going to move over, it's going to move from retained earnings into common stock and then paid-in capital in excess of par when we do that journal entry. Okay? So now let's look at our example. Okay? Let me just continue talking about this balance sheet. Actually, I want to focus here again a little bit more. So we have our common stock, 100,000 shares issued and outstanding, 100,000, paid-in capital in excess of par, total paid-in capital of 108, and then retained earnings of 35. It gives us our total stockholders' equity. This is before we did our small stock dividend that we just did in that prior problem. And then this is what I wanted to show you. This is after. Okay? So let's look at the balance and retained earnings. It's 15,000 after. It was 35,000 before. The difference is that 20,000. Remember, we debited retained earnings for that 20,000 and basically removed it out of retained earnings, and we moved it into total paid-in capital. But the total stockholders' equity remains the same at 143 and 143. It's just I moved it to different accounts. Moved it out of retained earnings and then eventually into total paid-in capital, because you can see our total common stock goes up, and then so does our total paid-in capital. Okay? So now let's look at our example of when we have a large stock dividend. Okay, which again is more than 25%. All right, so here we look at our example. It has 50,000 shares of $1 par value common stock outstanding. On December 31st, Router declared a 40% stock dividend when the stock was selling for $8 a share, and that stock will be distributed to stockholders on January 20th. Okay, so this is the date of declaration. This is the date of payment. And let's look at our journal entry here for the 31st. And with a large stock dividend, what we do is it's a slightly different journal entry. Okay? So what we do is we come over here and give me a second just to turn the page over. Okay, hello and welcome back. So I turned the page over and worked out the problem for you. I wanted to do that just to avoid any focus issues with the camera. And so when we look back at the example, it says our company has 50,000 shares of $1 par value stock outstanding. And then they declared a 40% stock dividend when it was selling for $8 a share. So the par value is $1 and then the market value is $8. They have 50,000 shares outstanding and they're going to do a 40% stock dividend. Well, that's more than 25%, so this is considered a large stock dividend. And when we have a large stock dividend, what we do, we record that by capitalizing retained earnings for the minimum amount required by our state law, which is the par value or the stated value of the stock. So what I do is I take those 50,000 shares outstanding times my 0.4, which is my 40% stock dividend, gives me 20,000 new shares that I'm going to distribute. Okay, times my dollar par value gives me $20,000 right over here. And so then what I do, capitalize retained earnings for the par value or the stated value. We're not given the stated value, so we're using the par value is the minimum required amount for state law. So I will decrease retained earnings by $20,000, and I decrease retained earnings with a debit. So I will debit retained earnings for $20,000, and then I credit my common stock dividend distributable. This is on the date of declaration for that $20,000. This is just that temporary equity account that I use for my date of declaration. And then, of course, when I pay this out, I will debit this, and then I will credit common stock, just like what we did for the small stock dividend. Okay? So, when we look at some of the notes on this transaction, this is just kind of repeating or reinforcing what I was just talking about. So the corporation will be debiting retained earnings for an amount equal to either the par value or the stated value. The date of the payment, just like what I was saying, we debit our common stock dividend distributable, and then we common stock. And then the effect on the balance sheet is similar, okay, except we don't have that paid in capital of excess of par because we're only dealing with the par value, not the market value. Okay? So the last thing I want to talk about in this lecture video is a stock split. So this is a distribution of additional shares of stock to our stockholders, but it doesn't affect their percent ownership. Okay? So when we have a stock split, basically the corporation calls in its outstanding shares and then issues more than one new share in exchange for each old share that it called in. So it could be, for example, a 2-for-1. So if you have one share of stock, the corporation does a stock split. Now you have two. This will reduce the price of the stock because the supply now of outstanding shares has gone up. So a company might want to do this, a stock split, to keep the stock price affordable. And so when that stock splits, now you have 2 shares for each 1 share or 3 shares for each 1 share of stock that you have. Now the price goes down of those shares of stock, but as a shareholder, what you may see or hope to see, right, is that over time, those share prices increase to what they used to be. Now you have not 1 share of stock that's worth $100. You have 2 shares of stock that are each now worth $100. So now you have $200. Okay. In terms of the accounting here for stock splits, there's no journal entry. It doesn't affect paid in capital or retained earnings, but it will affect our stock account description. Okay. All right. So that's what I wanted to talk about in this lecture video. So I'm going to end this lecture video now. And then the next one, we'll be doing some quick check problems associated with dividends. Okay. Thanks so much. Bye.